Okay, this is a financial innovation and economic crisis session. If you're looking for serious, religious-oriented thought, you're in the wrong place. This is the most irreverent group of four people I've ever been associated with in terms of preparing.
Where's the fourth?
I'm the fourth. Oh. Thank you. There, QED. Myron Scholes on my left probably doesn't need an introduction. Nobel Prize in '97 for his work with Fisher Black on options theory. He's the Frankie Buck Professor of Finance Emeritus after 31 years at Stanford. He also taught at Chicago and MIT. He's a Hoover Fellow. He's the chairman of the board of Stamos Capital Management and four other past and present asset management firms. He's an obvious luminary in our field, no matter how you define it. On his left is Tanya Bader, who's the founder and chairman of SBCC, which I'll let you illuminate us on if you choose. She's the lady in red from earlier in the day. You took 12 years off after founding it to have senior positions in two asset management firms, and is the author of a book called Financial Engineering, The Evolution of a Profession, that begins in 352 BC, I think, if I did my homework right, and not your work, the work quoted in the book. And Jeremy Bulow, who is the Richard Stepp Professor of Economics at the Business School. He's co-editor of the AER. He's written books articles with any number of luminaries that everybody recognizes the name, including Ben Bernanke, who actually hasn't been much of a luminary over the last this day, and is the director of the Bureau of Economics of FTC. He's currently teaching a class on the financial crisis here at the Business School. I will start this off by saying that at the Financial Crisis Inquiry Commission, there was some testimony given, and there was a guy who was asked, the senator from North Carolina, retired senator from North Carolina who was on the staff, asked these four people what was the cause of the financial crisis. And a lawyer gave a thoughtful answer, a former derivatives guy gave a thoughtful answer, a banker gave a thoughtful answer, and some guy whose name I've completely forgotten, and thankfully so, answered derivatives. And I was thinking, that's like saying that bullets were the cause of World War II. But Myron topped me, of course. Myron immediately said, no, that's like blaming the Wright brothers for 9/11. Myron Scholes.
Thank you. Actually, it's interesting when we talk about financial innovation and crises. You think that they always go hand in glove, and I guess if you look over a myriad years, they appear to in some sense. But I was thinking that, and then earlier today I just had some notes about finance and financial innovation from the discussions that we had, and I just would illuminate on a couple of them first before I talk about what I'm going to talk about in a second. But really, that we always have this view that there's the real economy and then there's the financial markets and the financial economy, and basically the real economy is doing something and the financial economy is just shuffling paper around, and that it has no purpose in the system. In fact, in China, I'm on a panel or a advisory board or whatever, and it's called the fictitious economy. When I was asked to be on the fictitious economy, I didn't understand what they wanted me to be on, and then I understood later it was finance, okay, because the real economy, so you have to have the real economy and a fictitious economy on the other side. So I was on the fictitious economy. In a lot of ways, I think that basically it's true that if we had a world that we were in the world of the first best, which was a world that, for those of you who are religious and remember the story about Adam and Eve, and we were in the Garden of Eden, and then everything was perfect, and everyone knew everything, and life was easy as back then basically finance would be far different. But we're in the world of second best. So in a lot of ways that finance is the grease, that makes things work, or presumably tries to make things work. Not that grease. the grease in the car, so to speak. I didn't mean to pun intended there. But so that basically, finance tends to compress time, make things compress time, and make things that are very large more idiosyncratic, and also more flexible, just the same way as manufacturing does in our society, and lots of other things we hear about that are happening all the time. So we are trying to be hand in glove with what else we see happening in the world. But the actual interesting point is that in finance, because of financial innovation, the way financial innovation works, that financial innovators are more like hunters, than farmers, and that basically in any economic system that the innovators have to be ahead of the infrastructure people. So you have the hunters ahead, or the war generals ahead of the ordnance generals, and basically that's what financial innovation is that it moves forward in a sense, and then infrastructure people come behind, all the lawyers we heard about earlier and other people who try to cement the institutions. The reason being because unlike when you know exactly the path to take, financial innovation is very uncertain. Many things don't succeed, and as a result of them not succeeding, there's failures to build all the infrastructure in the first place to be able to handle the innovation would be very expensive and non-productive for society. So we have that innovation leads infrastructure. We hope, and other times, that when you have infrastructure put into place, that infrastructure does not stifle innovation. As Secretary Baker said when he left as Secretary of Defense after serving for myriad years, he said, we have maybe, the armed services seems to be the best equipped and understands the most, but I don't know if we can fight anything, which is essentially his way of saying, in my understanding, that have the ordnance generals and of all the ordnance people taken over, so that we're really stifling our ability for the war generals to fight. We don't know until we have to fight. So basically, innovation has to be ahead of infrastructure. Infrastructure could stifle innovation. And we always have that balance to worry about in terms of thinking about innovation. And also we have the idea that that basically regulations and rules that are put into place have to be as dynamic as those who are trying to innovate, because one of the reasons we do get innovation or have financial innovation is to get around rules and regulations. I was once listening to and if we're going to have all the rules that are put into place under the current set, that basically things are fluid. They move. So if you set rules in place, that new innovations and creations tend to get around the rules if the rules themselves are constraining, and there's profit opportunities to actually abrogate or get around the rules. And that really a lot of what we are doing in our society is, and we should not focus on it. I try to look at financial innovation from the point of view of how does it increase the value of our human capital, and how does it increase the value of our physical capital in our society, and our penchant for continually focusing on GDP and the growth of GDP is really the wrong metric entirely. We should be looking at, do policies that we institute, does that affect the wealth of our society, which includes the value of our human capital and the value of our physical capital. Now, the interesting part about financial innovation is that the functions of finance are static, and you will see the same functions in China, India, United States, the UK, Greece, okay, the other Greece, not the grease of the wheel, but the other Greece as well. And those functions are static. But the institutions, unlike what we heard today and the last panel, last discussion, are changing all the time. Because when we look at a J.P. Morgan Chase today, or we look at a Wells Fargo Bank today, that which Wells Fargo is doing today, or other institutions are doing today, is really far different from what they did in the past, and they evolve over time. And their functions stay the same, but there's an evolution. And basically the functions that have been enumerated in finance is one is facilitating transacting and enhancing trade. That's the number one function, transacting, that facilitates transacting. The second is financing of large-scale projects, whether the project you're financing is from microfinance for some woman in Bangladesh who doesn't have enough resources to be able to finance her project, to building big infrastructure projects, whether it's trying to finance railroad systems or other large financial projects. The second one is financing large projects, larger than the resources. And one of the things that we have in our society is teams of individuals with ideas, the team of the value of human capital, trying to marry its expertise with physical capital or money to finance these activities. And it's that bringing together of ideas with money. You know, hopefully, sometimes the money doesn't have any ideas. They have the money, but at the same time, the human capital has ideas without money, as we know here in the Valley. The third function is really savings function, going from saving for the future as opposed to spending it all now, and figuring out ways to transfer resources over time. The fourth function is risk sharing and risk reduction. How do we transfer risks in our society? Who holds them? Who holds the securities, how we understand that transfer process working. And the fifth function is pricing and valuation signals. If you have a private equity firm, you don't know what the underlying prices of the deals are. You have to estimate them. When you have a stock market or a futures market or other markets, commodity markets, you have prices and you have valuation signals, which you can then use as ways to make other transactions and changes in portfolios. And the last function that we have in finance is figuring out ways to reduce market frictions, to reduce the idiosyncratic information differences that exist between those who have information. And it's the hidden information problem, where I ask you about a deal and terms of a deal, and you still can have hidden information that I don't know about. And then obviously when you hire agents to do things for you, like you hire money managers to manage money for you, you hope they'll manage money the way you want to manage your money, but you have that information asymmetry. Now the interesting, just an illustration of all these just quickly, is that I was on the board of financial technologies in India, and that what financial technologies did was give a handheld calculator to farmers in rural parts of India, a mobile phone essentially. And prior to having the mobile phone, the farmer would grow their wheat crop or their rice crop, and it was a rice crop, and that some person would come to the village, which was remote, and say, the price of wheat is such and such, and you should sell your rice crop to us. And the farmer would do that. With the handheld mobile phone, when the middle person would come to their village, they could see on the mobile phone what the futures price of rice was in Mumbai, and decide whether they want to sell to the middle person that came in. The last month of the rice crop, when you have the rainy season, is the time in which the rice might be destroyed. So the farmer could decide then, holding that handheld device, whether to hedge their crop at that time, or what portion of their rice crop to hedge. And then what happened was that it became obvious to financial technology that to store rice prior to their developing this technology was that rice would be stored, and it was amazing how much of the rice that was stored for these farmers seemed to disappear. But so you set up bonded warehouses to set up an infrastructure that would able to store the rice, and so you had here transacting. They could sell their crop then through the futures market and took delivery into the bonded warehouses. They had a way then to finance their particular crop, because once they could hedge their risks, they can go to local bankers, or others could set up a way to be able to finance their projects. And what they could do is also share risks through the use of the futures market, and they had pricing and valuation signals, and they could reduce frictions because they had more information now than what was told to them. And last, what they could do is through thinking about the idea, once they had these resources, instead of being able to only realize about 20% of the economic value of their crop, they were now at 80 to 85% of the economic value of the crop, and they built human capital, because with the excess money, they built their villages. They then built educational systems in their areas because they had more wealth, more retention of their wealth. Then they could store for the future, through human capital and building physical capital as well. Now, the interesting part about financial systems and the like, even though these functions are so crucial, that basically with the uncertainty that we have about the evolutionary uncertainty, that markets themselves, because they are so fluid, so changing in terms of what can be provided, that crises will occur. The way markets work, in my view, I'm going to talk about this later, is that when we see things that look as though they're calm, does not necessarily mean that that's the norm. That when we always will see markets that are chaotic and markets that are calm, through the whole process, the evolutionary process, the intermediation process. And I was trying to set the stage here, just the introduction, before talking about crises, and Jeremy will probably pick up on that, as to what the functions are and how important they are to make our economies work. So I'll pass it on to Tanya at this moment.
I'm just going to start off by making the statement that I think that innovation's had a really bad rap in general, and it's largely been equated recently with, for example, subprime CDOs. So innovation equals subprime CDOs, so therefore it's bad. And what I want to do is set a little bit of a historical context and then talk about some of the innovations I think are coming down the road that are really wonderful. And the context I want to do first is by analogy, to make the point that very little innovation actually comes without some unintended consequences and without some misuse. So we'll take the example of the personal communication device. Myron gave a great example of where a personal communication device does something wonderful. It helps the farmers to do the hedging of their crops. It helps you make phone calls, you can take pictures, you can transfer funds, you can look up directions, you can find out where the closest bank is, but at the same time, the personal communication device also is responsible for drastically increased traffic accidents. It's been linked to causing brain tumors. It's also, no doubt, something that creates a lot of aggravation for people, whether they are flight attendants trying to get people to shut them down as the plane's taking off, or whether you're sitting in the theater or a restaurant and don't want someone having it go off. So there's unintended consequences and things that are the bad side, but by and large, it's been an innovation that also has some very good sides when it's used properly. If we look at some of the innovations on Wall Street sort of in a similar context, and look up just to the mid-1970s, and I went to Wall Street in the late 70s and first started on the street then. And in those years, there were no computers on the trading floor. In fact, a HP 12C calculator was considered to be pretty fancy. There was a Monroe bond calculator. It was open outcry in the pits. Stocks traded in eighths. The theory of finance was way ahead of the application in those years. I mean, there were lots of wonderful formulas, including the Black-Scholes formula for options. We had the whole techniques in place for doing things like complex simulations, but if you actually tried to use the simulations, you got the answer 2 days after you wanted to make the trade. So it wasn't particularly useful. We then went through this huge period of having another dimension sort of start to catch up to what the theory was, and that was really the technology side of things. And on the technology side of things, we got to have every year where you could buy twice as much computing power for half the cost. We got to the point where you could put the size of the ENIAC computer, the very first computer, into the size of a baby aspirin, where you could buy a workstation instead of for hundreds of thousands of dollars for $10,000. And we got to the point where in the cycle, and I think Myron referred to this, talking about the relationship between the infrastructure and the creation of instruments actually got much faster than the infrastructure to support it. I was actually a swaps trader in the very beginning after doing mergers and acquisitions for a while, and the first year of interest rate swaps, I think it took us a year to get to the point where 25 billion was even executed. And it took a really long time. People expected if someone came in to talk about a new idea that was the rarity in terms of how the relationship worked between Wall Street and the customers. Within a few years, it was at the point where if we came up with a new idea in financial engineering, we did 25 billion by lunchtime. And people who were on the receiving end of all the innovation were having to cull through dozens of proposals almost on a daily basis in terms of what the new strategies were. So with that kind of speed, it's not surprising that things got into a few problems, but that's not to say that there aren't, just like with the cell phone, a lot of really wonderful things that come out of that innovation. I don't think it's something that you can put back in the bottle at this point, despite the fact that something like a lot of the Dodd-Frank regulation and some of the other regulatory controls are in fact trying to do that. I'll just suggest a couple of the places where I think that we need to and will have some wonderful innovation coming down the pike here. One is actually on the retooling of securitization. Securitization is something that's very necessary to help financial firms to turn the inventory on their balance sheets. Actually, if you look at the growth of securitization, it went up like a rocket, and then it just fell down to earth, but there was one part that actually stayed somewhat consistent, and that was ABS manufacture outside of the mortgage area. And the reason it did is because I think that there became a lot more transparency in the process. People had to do a lot more work on guaranteeing the quality of the loans going into the packages. There was a lot more capital required of institutions who were packaging them. Investors got a lot of comfort through some of the government programs that were backing them up. And I say that because I think that there's a message in there about what I think will be this next stage of securitization, which is not as a new innovation, but a retooled innovation. And I think we'll have a world where first we have Dodd-Frank that I think will have a lot of unintended consequences, but we'll move from that into one where we perhaps have some simple rules. For example, if we just had a rule that said, every single stage of the process in a financially engineered creation has to have each stage on the market. So you can't, for example, sell subprime loans that are not worth $1 for $1. If they're worth 10 cents, they have to be sold at 10 cents. And if there's pressure on the pricing at every point to sort of do the right thing pricing-wise, you actually would have stopped the CDO market dead in its tracks. So I think that innovation will be alive and well with some small improvements along those lines. And if you look at where some of the great new products are going to be, I think it will be on doing things like helping, for example, the governments of the world, who are now the largest hedge fund operators in the marketplace, because they bought all of the product and they're financing it. And so all the taxpayers were actually all investors in very large hedge funds at this point. And those assets will need to be packaged and moved into the market. And this is where the aspect of risk that Myron talked about is very important, which is trying to get those risks into the best holders of those risks. And I think that finance will perform that distribution function, and we'll see a lot of very exciting innovation in this next period.
Well, as Carmen Reinhardt and Ken Rogoff have shown, financial crises and sovereign debt crises are nothing new. They've been happening for at least 800 years before the development of stock and bond markets, let alone derivatives, CDS, securitization, subprime mortgages. So financial innovation alone is certainly not responsible for crises. Were there actions taken by market participants that some call financial innovation, which did contribute to the crisis? Yes. So, for example, a large part of the AIG derivatives book was motivated by regulatory arbitrage considerations. Banks were incentivized to issue and hold much more subprime debt than they would have under a mark-to-market system with appropriate risk haircuts, as Tanya referred to. Many other transactions, or in some cases non-transactions, were motivated by regulatory accounting and tax considerations. Unless you have a system that is neutral to the form in which an asset is held and to the holder of the asset, there will inevitably be a lot of non-economic, quote-unquote, innovation to game the system. So some examples of the consequences of what happened. On the capital adequacy side, if you look at U.S. commercial banks over the 70 years of most recent data, 1941 to 2010, the 7 years in which they were best capitalized in terms of the ratio of equity to assets according to the FDIC were the last 7 years. Of the large U.S. banks at the end of 2008, in terms of regulatory capital, the one that was in the best shape was Citibank. Institutions from Lehman in the U.S. to Dexia in Europe went bust shortly after reporting regulatory capital, more than double the requirements. In Dexia's case, after having passed a stress test 2 months earlier with flying colors. On the tax side, the 4 foreign countries where U.S. firms report making the most money are the Bahamas, the Cayman Islands, Ireland, which has 4 million people, and the Netherlands. In the Bahamas, they report profits equal to 646% of the country's GDP. We have a presidential candidate who managed to build up a $50 million IRA account despite the $2,000 a year limit on contributions. It wasn't all good returns. The structure that enables this, the structures that enables this to happen are applications of tools that, in other contexts, serve useful purposes, like improving the allocation of risk and capital. The line about the Wright brothers is actually not Myron's; it's mine. Myron is much too modest to compare himself to the Wright brothers, I think. But it's true nonetheless. You know, it really wasn't those legitimate financial innovations that created the problem. However, what I think we do need to do is move to a tax and regulatory system without the massive distortions that we see today. In terms of capital regulation of financial institutions, I think this can be done if we are willing to rely more rather than less on the market. So, for example, hedge funds and private equity funds are effectively limited in their leverage through what the market will provide. And I'd call that market-based regulation. Most of those firms lost money during the financial crisis. Some even went broke, but they did not impose systemic risk. Commercial banks, with their enormous amounts of government-guaranteed money and their historical accounting-based regulatory system, were at the center of the crisis, both here and in Europe. Bacot talked about the lender of last resort lending on stiff terms for good collateral to financially solvent institutions. Compare that to what the ECB was forced to do these past few months, lending hundreds of billions of euro on loosened collateral standards to institutions that most people think are insolvent. As long as there's risk and uncertainty, there's going to be losses. I think a system that says what's going to happen next time is we're going to figure things out in advance so that nobody's going to lose money is a recipe for failure. If you have market-based regulation, I think that doesn't eliminate losses, but it can require firms to deal with them more promptly. And if we have a more market-based system, the incentives for tax and regulatory arbitrage, which can be unproductive and destabilizing, can be diminished.
Anybody want to comment on the subsequent? Yeah.
Well, I'll make one comment following Jeremy's remarks about the regulatory and tax and even accounting arbitrage that happens, and that's that it's certainly been a huge driver of some of the innovation that's happened on Wall Street. And in that case, I put innovation in quotations because I think that one of the changes that needs to happen is that innovation becomes firmly grounded in economics or in the need to disperse risk into the right holders. I mean, if you even just think about the problems that happened at AIG or with the big monoline insurers, and you start to look at the size of their capital base, which was very small compared to the size of the risks that they were insuring, it wouldn't take a rocket scientist or someone, in fact, even with a very high level of education at all, to see that that was a cocktail for disaster. And one of the things, right, that I do think innovation will help with in this next cycle is that, we've gone from having most of the risk held by individuals to having it held by the banks to now having it held by the governments. And the question is, where do you go from there? Actually, Myron and I at lunchtime were talking about the God CDO. But since it's unlikely that that's probably the place that risk will be placed, it has to come back somehow into the economy, into the right holders of the risk. And I do think that the good news is that there's a lot of very clever folks who do participate in the financial markets, and that's been extraordinarily high growth as well. If you look at when in the 70s on the trading floor, there were maybe 3, 4, half a dozen quant folks on the trading floor. That became 25% PhDs by the time you got into the 90s, and there are now 160 programs around the world that do some type of degree in really innovative areas for finance that didn't even exist 3 decades ago. So there's a lot of training and I think a lot of opportunity to get that right, but as long as there's an incentive to create products to arbitrage tax or to arbitrage bad regulation or to arbitrage bad or inconsistent accounting treatment, I think a lot of good energy creates products for the wrong reasons.
I think that there's so much that we learn from finance that, finance really is the area of trying to think about uncertainty. And the idea that uncertainty, as opposed to just trying to project the future as though it's as the past. And as we heard in some of the talks today, that tends to be what people do. They data mine the past, and that's a projection of the future. And we try to learn in finance is that there's just more than just a prediction. There's the idea of trying to think about the outcomes and how uncertain they are. And everyone makes mistakes in doing that, and finance is one of the more fluid areas. But If you look at governments today, governments are always projecting their budgets or these straight lines. There's so many straight lines. We said, but what happened? We never heard one question. What if there's a shortfall? What if it goes the opposite way? Or what if there's a boom and it goes on the upside? What's the consequence of that? And how do we adjust in those states of the world? So basically, thinking about uncertainty as part of our decision making is very crucial. And finance has a lot to say about that. We have the problems that I see going forward, which we're going to need huge innovation in, is demographics is one of them. We're going to have a growth of populations in the next 10 years or so, maybe to 9 billion or so people in this world, and over 50% of them are going to be living on less than $2 a day. We need innovation, lots of financial innovation to handle this question of poverty and to really understand what 4.5 billion people are that are going to be living in poverty, as we know what's happening in the Middle East and other parts of the world, and with regard to just poverty. We have an aging population in the West, and we know that we have low pension benefits. Bill Sharp has been working on these issues and thinking about them for a very long time. But what's going to be because of the loss of wealth or the fear that governments won't be able to provide for retirement benefits for people as we move the function of savings down to the individual and away from the governments and corporations. There's a huge amount of financial innovation that has to be handled for that part of the world. The health of populations and the providing of healthcare services, there needs to be financial innovation of all these areas. And additionally, we're going to have vast movements of population around the world. It's not going to be static. Migration is going to have a huge effect on our societies. Technological change is another big area. Demographics, the first one, technological change, but how we're going to finance the information technology, what the effects of information is going to do on financial innovation and controls, what biology, nanotechnology, neuroscience, all those are going to need to be financed and funded, and that's going to need a large amount of new ways of thinking about it, and they will evolve over time. And scarcity, the idea that we have water, energy, renewable energy, ecology, all of those are going to need new ways to be financed, new ways to be evaluated, new ways to think about how to transfer risk, transactions that are going to be afforded. If we even look at innovation that's occurred, we know that's going to come in the future is that none of us will carry cash anymore, and we'll go to the supermarket. I do go there occasionally, but you go to the supermarket and you'll go and wave your mobile phone around, and basically it'll check you out, and you'll have all these transactions occur, and we don't have to carry the boulder around anymore. All those are ideas of making things faster, more idiosyncratic, to be more compressing time. When markets fail, when intermediation fails, the process of intermediation fails, time is no longer compressed. It expands. The intermediate transacting is more difficult. Financing projects is impossible. The idea of market prices are chaotic and unknown. Information costs go up dramatically. So when we don't want markets to fail, we don't want things to become that way because we can no longer handle the needs of clients. So we don't know how to not allow markets to not fail. I agree that some of the innovations are perverse, as Tanya and Jeremy brought up. We have to also stress the value added of technology, the value added of computing, the value added of telecommunications, and our knowledge of how to create innovations in the financial area which enhance the value for all of us.
Listening to the three of you, I had a thought that I haven't had for a while. But imagine
good thoughts earlier today.
I know, and we'll have this one left. If you look at, imagine a world without financial innovation that has this nice, slow, steady growth of GNP or personal income or whatever for citizens. And then imagine into that world you introduce financial innovation, materially increase people's ability to improve their standard of living, increase their incomes, improve their GDP, but it comes at a cost of higher volatility. Okay, because you basically can go on the nice, slow, steady growth. We call that the turtle path.
The value add.
On the hare path, and it goes up and down, up and down. George Shultz made a comment yesterday at our board meeting that economists look at the benefits of that. He wasn't talking about this case, but economists are geared to look at the benefits of that faster track, but it's politicians who are geared to look at the losses from that greater volatility. And so there is a stress introduced through financial innovation in this simple example, where the higher growth path might be preferred by even a majority of the citizens, but there are going to be winners and losers, and the losers there's stress created.
Well, I'll start, but then the problem is that we're in an uncertain world to start with, okay, and that we don't know the information set. If we knew what projects to take, it would be easy. One of the reasons we're not growing as fast as China is, as was mentioned earlier, is because we can't look where the birds flew, okay? If you want to grow your economy, and it's kind of stupid not to look at what's been successful somewhere else. And we know that all of us in business, we're always looking at competition to see what was successful. We're not going to do the things that didn't work, unless we can think why they didn't work and improve them. But we copy what's successful. So the problem is we have to realize that there's huge amounts of information, large uncertainty out there. The information set is vast. It's just, we don't know everything. We're in the bamboo trees, okay? And we try to think about which path to go, to the right or to the left, and uncertainty is endemic. Now, it's true that you can I think about finance, or the idea of innovation, is trying to facilitate enterprise. It's trying to facilitate growth, okay? It's trying to make the economy better through what I said were the functions of finance. And obviously, just as there's failures associated with, in an uncertain world, there's failures associated with in the real economy, there's also failures in the fictitious economy. When failures occur in a fictitious economy, it affects the real economy and vice versa. So the question is that we can't put things in a jar, and you can say, let's stifle innovation, but stifle innovation has a cost. And so that's the real fundamental trade-off.
I hope I didn't say anything that causes you to think I'm on the other side of that. I agree with you.
You did, but I forgive you.
I think we should keep in mind that volatility in national income and people's incomes has not increased on the whole from what it's historically been. I mean, we've obviously got a crisis right now. One other thing I'd just like to mention, kind of following up on a couple things that Myron and Tanya were saying, is I think it's important to keep in mind as we think about regulations that the government is really not a good bearer of tail risk. The average stakeholder in the government is not able to bear risk as well as the average owner of the capital stock who tends to be wealthier and more sophisticated investor. We also know that the government is not good at saving in good times to cover the losses in bad times. Myron was referring to the stuff that Bill does on pension funds as one example. And being able to save in good times so that you have something put aside for the bad times is one of the necessary skills to be a good risk bearer. In Silicon Valley here, we can look at the bubble from 2000, 2001. All of us who were here who maybe made some extra money during that time because of the bubble, our incomes might have gone back down to what they were before in 2002, 2003. But the fact that there was this windfall in 2000, 2001 meant people had more money than they would have if the bubble had never happened. You look at the California state government, they were in a lot worse situation in 2001, 2002 than they were before the bubble because, their income went up and they're not good at risk smoothing. So I think it's important as we go forward to realize that we need to design ways of not having the government be this bearer of tail risk. That hasn't worked very well.
I think there's one other factor that accounted for some of the problems too that is important to separate, because I think it's one thing that will start to work itself out over this next cycle. And what that is that there's the economic motivation or the arbitrage motivation for the tax, the accounting, whatever, and then there was the difficulty with the math and the operations. And In our firm, we actually have cleaned up quite a number of, or worked on cleaning up a lot of the world's train wrecks. And the vast majority of them aren't because, for example, volatility increases or someone really makes a bad trade. It's usually due to operational issues or infrastructure issues. And remember the contrast I was making, in Wall Street in the 70s, when prices changed on the trading floor, someone erased them on the blackboard and then wrote up the new price. And things like the pink sheets were delivered every other day to tell you where the prices had changed to for a lot of the smaller stocks. And when you contrast that to where we went, which was getting down into, fine decimals and going from trading a very low volume of stocks to a high volume, these complex instruments, frankly, the mathematics of derivatives and complex securities, I quite liken to the analogy of dating. It's what you want to see across the table from you, and people often see things that they want to see versus what might be there. And I think examples are, if you look at some of the models that were underneath some of the financial innovations, or you even look at value at risk. I mean, value at risk, you can look at two ways. You can look at it as how much money I'm going to lose some percentage of the time, 95% or 99% of the time, according to my historical modeling, where I've made a lot of assumptions. Or you can say, oh my goodness, how much am I going to lose the rest of the time? And those are two very different ways of looking at the risk, and people knew that we were living through multiple once-in-a-100-year events every year. But in that dating mentality, they were saying, oh, good, I'm calculating the risk numbers, they're right. I think that part is actually going to get really fixed in the next evolution of the financial markets, if for no other reason than it's generational. The ATM was a really big development, and then it was a really big development to get a computer on the trading floor. People in the large banks were very wed to their legacy systems. Why? Because they'd amortize the cost of them. And once you amortize the cost of those legacy systems, you don't want to spend millions of dollars putting in new and expensive software. Whereas now we have a generation who, as soon as you hand them the iPad 1, they say, when's the 2 coming out? Or you hand them the 3 and they say, when's the 4 coming out? And they're very used to having an evolution of software and technology and new ways to look at things. And we also have a much higher training technologically and mathematically of management who's been coming up through the ranks. So I think that those will be very positive towards solving this other aspect of innovation that created the problems. It wasn't actually that necessarily bad products were made. It was that they were frankly really misused, and then also in the eye of that beholder, in the dating analogy, people were seeing the aspects of the upside and not with what the rest of the numbers were really telling them. And I think we'll really improve that on this next cycle.
Let's see if there are questions from the floor.
Thank you. I found myself stimulated and in agreement with almost everything that the panelists were saying. I wanted to pose a seemingly simple question, and I'll ask the question, and why it's actually not so simple. So while you're thinking about it, I mean, there were questions which are easy to frame, maybe harder to actually give an answer to. The question is, if you're thinking about innovation, and you can address this in the financial innovation or technological innovation, whatever you like, is there an optimal rate of innovation for a society? And can it be defined? Can you frame it without reference to the society's institutional, regulatory, infrastructure capabilities of actually dealing with and adjusting to the innovation so that its consequences are socially beneficial? So while you're framing your answers, let me just suggest a way that I've started thinking about innovation, which is just starts from the fact that you could think about innovations as mutations. Mutations usually involve adding some or a single new process to an existing subset of processes, which will then do something to the system. Okay? Most innovations don't do very much to the in biology, to inclusive fitness for the system. It doesn't affect that. A certain substantial number of them turn out to produce phenotypic monsters, which have greatly reduced viability, and those don't persist. If you have very, very high rates of innovation, evolution doesn't work because of what biologists tell us, and even evolutionary game theorists now tell us. Because they're economists, they were able to prove that something that's been working in practice for a long time can also work in theory. They've shown that you have to have a pause in the game. If you play this game in continuous time with continuous innovation, that the traits that will allow evolutionary inclusive fitness for species to grow, and so they get fixed and expand, they won't get fixed in the population because the innovations are continually preventing that from happening. Okay, so you need slowdown. So at least that suggests that the optimal rate can't be unbounded. So the question is, how would you define it?
Okay, I think that the issue you bring up is indirectly is that the idea of itself is learning, and your assumptions about innovation is velocity or change, how we change things or why we change things. And part of it is exogenous, observing of other things around us, and part is endogenous, is I'm changing and learning, other people are learning at the same time. But in science or in life, you always have to have a fixed point as well, so you can't just have velocity. So that we make assumptions about fixed points or where we're trying to go to. So a firm, let's give an illustration. You say, well, I think that the stock is undervalued, and it's going to go to a certain value, or you think that my product that I'm going to bring out, or the financial product that I'm going to bring out, is going to have a lifespan of 5 years before, and I'll make profits doing that for that period of time, and then competition will come in and people will reverse engineer what I do and copy it, and that. But there's assumption about the fixed point. It's an assumption, because to do things in finance, you need to have not only change, you need to have a place where it's going to go, or an assumption it's going to go. That's obviously false in that assumption. So the example that I give is, in my thinking, is somewhat akin to what you're saying, is that we observe. I use sort of an analogy of the children in the playground. We cross-sectionally look around us, and we see from the cross-section, we have an idea that some children are in a group by the swings, and other children are in groups by the baseball area or whatever. And we know that that's a computationally difficult problem, because it's sort of the clustering problem. We define clusters by looking at cross-sectional things, and we define clusters. And the problem is that there's a clusters. If we could define the number of clusters beforehand, then we can group people optimally. But we know it's very difficult to do, because we don't know what the number of clusters really are. And then once we sort of make an assumption about the clusters, which are false, okay, we innovate and do things realizing these are the clusters, such as how we group securities into portfolios, or how we think about building mutual fund products, or all these other products that we build. Those are the clusters. And then, then what happens, that's a description or a manifold of what we see. And then all of a sudden, all the kids in the playground start moving to, there's an attractor, and then all of a sudden they're moving to a new location. And we don't know what the attractor is. We can assume what's causing everything to change and be dynamic and fluid. And maybe there's an ice cream truck they're attracted to. And then the teachers are stop the children from going to the ice cream truck, and then when the children leave the ice cream truck, they don't go back to where they were before. And so the system, when the children are trying to reorganize themselves into new clusters and new things, then we can then have an ability to see what they're doing under this uncertainty that we observe, and with the intervention of governments and others, which adjust where they end up going to, they're not going to return to where they were. So we assume in a lot of government policies, we assume in our economy, make an assumption in monetary policy and others that the children return to the clusters they were before, so they believe in a system of return. But that's impossible. So once you, as Tanya said, once you learn about these things, you don't return to where you were. And so the system becomes very chaotic until we can again approximate where the children are, what these clusters are, and they're all not correct. So to get to your question is, to get to your no, it is a good answer. No, it is to your question. It is to doing it, because in the uncertainty of what the clusters are and what we observe because of that, then how do we know what rate, how to slow it down or how not to do it or what the growth is? We know the following is true, that in some sense, if the innovation gets too far ahead of the infrastructure, that's incorrect. And if you allow the innovation not to go because you're constraining the kids from going anywhere, that's also not correct. So that is a very tough problem, because you don't know the answer to that. Sometimes, you can get innovation to be very fast and everything's fine, and you don't, and myriad things like in transacting, we don't talk about failures in transacting. Some failures have occurred, but we've had great innovation in transacting from over the years, and at other times we've had failures in transacting. We get the flash crash. We had very high-speed transacting. Models worked. Models started trading, and the market went to zero in some stocks in a matter of minutes. Okay. Other times things work beautifully, but you don't know that in advance. That's presumably the heads of the organizations that are running these are supposed to. That's their job, is to try to figure out how to keep the infrastructure to support the innovations close enough to where the innovators are, and they fail at times to do that.
But I understand your question. If I could summarize your answer, is that yes, you can't define an optimal rate without reference to the regulatory capacities of the system, the infrastructure capacities
within the system,
and still get a socially efficient result.
Right, but the point is that. But who would do it? Is it better to have, as Jeremy said and Tanya referring to, an internal regulatory structure or an external regulatory structure? And the idea.
I don't say anything about who should do it. It's just that if we decide that we're underinvesting in that, then we should figure out where should the investment.
But that's what the job of every firm is. Every firm, whether it's a financial firm they do it, but some firms fail because they don't control or they do control. That's part of business.
But if there are externalities from that failure, then you would think there ought to be some other policy.
But how can that other person do it?
Well, it's possible for society to organize to deal with externalities. We have a lot of policies that we justify as economists because they are fixing.
No, I appreciate that, but I'm saying that
okay. No, I don't want to stop you.
No, I'm sorry. No, I agree with you. I agree with you that those policies, that as was said, if you have a crisis like we did, is there a choice, as said earlier today, that we throw at all learning, we don't learn from what has happened, and we have a new bill such as the Dodd-Frank bill or other regulatory actions, and we had little learning, but there is huge learning that goes on in the system. And so it is the job of, or the new management that takes over, presumably senior management in organizations such as the banks, the responsibility to be strategic. So they're supposed to manage the spread between the growth of their innovations and the growth of the infrastructure. So the idea that's a responsibility.
But we're left, it's a fascinating question. Is there an optimal level of financial innovation? And if so, is there a way to determine what it is? And of course, it's a function of all of the realities of the markets. So I think it's a great question. There was a question back here and then here.
I got the mic, so. In your comments, you guys all briefly touched on Dodd-Frank. I would just be curious to see, what are some of the most egregious unintended consequences that you guys see coming out of the legislation?
Go ahead if you want.
I guess I would not use the word egregious as much as I would say that the more complicated the system is, the more opportunity there is to arbitrage and create things to go around it. And then that just increases the opacity in the system and makes it harder for management and everybody else to make sure that they're stepping in the right direction. So I think that's what's most wrong with it, is that there was this mandate to just create an incredible number of rules, and all of those rules are then making even more complicated a regulatory infrastructure that probably isn't aligned with how the financial system works and operates today.
I would say egregious. Three counts of egregiousness, if it's a word. One, it does absolutely nothing to go toward what it was aimed at doing, which is to prevent too big to fail in the future. There's nothing in it that deals with that. Number two, it hands over arbitrary and vague ways to regulate markets in the hands of people who don't understand the markets. And oops, I actually did forget number three. So
a third one, which I have, is that we've created a black hole, because the new authority, which is presumably, instead of trying to look at the bankruptcy law and see how we can make things more efficient or make it such that if we have, we're trying to protect depositors, and the idea of moral hazard in our society, try to reduce that by bailing out financial institutions. And even though Mr. Geithner said that we'd never bail out another institution, he was forcing Europeans to try to bail out all their banks, okay, through these policies of the ECB, et cetera. So, the issue is that what we did is created a black hole, because what we have now is this systemic or too big to fail issues, so that the FDIC or some regulatory body can take over a bank that looks as if it might be systemic or it might cause difficulties. But the minute you start doing that, then it creates a whole system ties to collapse. So instead of saying we eliminated too big to fail, we've now cemented it, that it's not going to be too big to fail.
I remember number three, which is now number four, which is Tanya's original number one, which is that the world's not static. It doesn't sit where Dodd-Frank thought it was sitting. It's not even there now.
Push more and more activity into the shadow banking system.
Correct.
Yes. There was a gentleman back here who had a question and got blindsided.
This is more for Jeremy. So, Jeremy, when you look at the history of financial history of the advanced countries, and you see there's that part of the growth that we've seen in the last couple of hundred years had a lot to do with financial development, and financial development had financial innovation behind it, and you had a series of financial crises. So the question was, do you learn from the crises? Well, in some countries they did, and the crisis was, in a sense, a signaling event, and they came up with either policies or other market institutions which could allow them to move forward. In other countries, it didn't work. So it's, I think it's related to Paul's question. I mean, it's tied in with the whole institutional structure of the country you're dealing with. But I sort of see it as generally for the U.S. and the U.K., et cetera. So there's 2 steps forward and 1 step back, and the crisis is just part of the process. But you shouldn't try to kill the mechanism by saying we've got crises, we've got to shut the system down, we've got to just regulate it to death, we've got to do what we did in the advanced countries between the 1930s and the 1970s.
Well, just for those of you who don't know, that's Mike Bordeaux, who's one of the world experts on the history of the financial system. I agree with you, and one of the fears that I think a lot of people have is that somehow or other the politicians, the regulators, and so forth are maybe taking some of the wrong lessons from the crisis that we've had. We all know, for example, that having a much more complicated tax code does not necessarily mean a better tax code. If you think about something that works well in the tax code, I would say, if I were going to point to an example, I'd say the taxation of stock options. People get their stock options. Nobody knows exactly what they're worth. They can estimate maybe with Myron's formula, but they have to put in the parameters. So instead they say, well, let's just see what it turns out that they're worth. Let the market decide. When the person cashes them in, they'll pay tax on the money that they made, and the company will get a deduction for the earnings that they paid to that worker. To me, that's an elegant solution, an elegant market-based solution that works, really well. I think we need to have more solutions of that sort, and going to developing our regulatory process. The idea that we want to count more on regulators, that next time we're going to have somebody who's even smarter than Ben Bernanke, who is really, really smart, that next time we have to have more people doing what the rating agencies were supposed to do and so forth. I think that's not a good way to go. So I think there are things that can be learned, and I do fear sometimes that we're taking away some of the wrong lessons.
Also just, the idea that there's always attractors that we don't know. There's always an ice cream truck coming, and that's life. And if all these attractors occur, so it's going to cause the clusters in the way we think about things to change, and that a regulator can't see that. No one can see that in some sense.
It's like, to reframe what Myron's saying, the TSA is really very good at making sure that next time I get on a plane, it's not going to blow up because some guy's got a lot of gunpowder on the bottom of his shoes. In terms of the other 99.9% of the risks that we face, I don't know how many of those they've got covered, but they've sort of set things up that if the guy tries exactly the same thing as last time, we'll sort of be okay. But that's not really a good way to develop a system.
No, it's a good way to cover your ass if you're a regulator. Actually, this gentleman had his hand up, and then here. Sorry.
Oh, thank you. I'd love your thoughts on how you think innovation will happen going forward in the next cycle. In other categories and sectors, it's been studied tremendously over the last 20 years, whether it was how Edison innovated, or Procter & Gamble goes out and studies people using their soap, and then they brainstorm and they come up with new soap ideas. But the path forward for how innovation happens in finance is maybe a little bit more black box. I would love your observations on that.
I think it has a big function of three things. Okay, one is computing power. The idea of what we can do, and just the same way as we get innovation in venture capital. For example, if we have the cloud, then the amount of money you need to start a firm, you don't need your servers anymore. Those things disappear because you can rent. And so the computing power, the way we compute, is very important, and the way we communicate is very important, telecommunication. And the idea, and the third is theory and understanding how to handle uncertainty in ways we didn't know before, and as a function of these various attractors, which gets us thinking about new things to do. So basically, one of the biggest problems that I see is essentially how we have taken, if we can only innovate, ways of moving from just using expectations. A lot of what we do in our finance teaching and economics teaching, for that matter, is really to assume certainty. The idea that if you're doing a valuation model for a project and you're forecasting the future, you might take it as, and then take the expectation, and then discount that to present value and say, let's take that project, for example. But that's only one path that could occur, and so we need a lot of innovation and trying to think about how to handle uncertainty of outcomes, changes in opportunity sets, how to really model these things. And so I think a lot of innovation comes from our theoretical learning as to handle things and our experience, and they evolve. But a lot of financial innovation is a derivative to the underlying business, and technology and those needs.
I was actually on Wall Street for 20 years doing derivatives, and every single innovation that I ever personally saw or oversaw was a direct function of a bright kid being in a customer's office and finding out what they needed and coming back and creating it. I mean, that was where the innovation came from. It wasn't something that we planned or that we built in a shop or that we outsourced to China. It was a kid in somebody's office listening to what they needed and delivering it. And that was where the innovation came from. If it turned into a product, great, but it didn't necessarily turn into a product. Okay, last question. I think we definitely have time for one more, if it's quick, too. Right.
Thank you. A two-part question, really. Your panel is labeled a financial innovation in the economic crisis. Clearly, we've had an economic crisis. Clearly, a great many people blame the securitization of mortgages as a major contributor, or the major contributor, perhaps, to that crisis. How much blame do you feel the financial industry should take to itself in terms of letting down the credit standards that permitted this? And what should it have done about it without requiring regulation? That's the first part.
You guys want to take? I have an answer, but I'm not on the panel. So.
I'll say something. Look, with the benefit of hindsight, a lot of those loans were bad loans that maybe shouldn't have been made. I wouldn't want to design a regulatory system that depended on people not making mistakes in the future, because that's a recipe for disaster. In terms of...
But there were more than mistakes. There were deliberate falsification of loans, a deliberate encouragement of people. And people knew this.
Well, on both sides. I mean, there are people who, you read stories about people who bought a house for $120,000 later, and $120,000, and 15 years later they're defaulting on their $500,000 mortgage, and how sorry do you feel for them? Well, they did the same thing that a lot of private equity firms do. Their assets went up in value, they took out their capital, and but let's just put that aside for a moment. Look, there were losses on these securities. A big issue is there was maybe $1 trillion of losses on subprime and Alt-A. We seem to get into a big crisis because of that. Compare that with losing maybe $9 trillion in market value in the NASDAQ crash, where we had much less of a crisis, hardly a crisis at all worth speaking of. You say, how does the $1 trillion cause this kind of, problem versus the $9 trillion? Well, part of it is because it was kind of focused in, the banking system, which is a nexus for providing loans to small businesses and so forth. And you say, well, what could have been done? Well, my view is that if we had a system that was more market-based, so that as these losses started to come in, banks were forced to recognize them and deal with the consequences, we would have had a lot of banks complaining, but we would have had much less of a problem. Citigroup's stock went from $55 a share, $275 billion market cap, down eventually to $5 billion, but it didn't happen overnight. It happened gradually over time. Even after Lehman, they were still worth $80 billion. They had a lot of time along the way where, if they'd been forced to, by a more market-based system, to go out and raise more capital along the way, they would have been complaining bitterly that their shareholders were so diluted. But at the end of the day, you'd have had some diluted shareholders and not the kind of crisis that we had. So my feeling is that we need to do is to have something that's more that forces the financial institutions, the banks in particular, to be more responsive.
Market-based or regulation-based? They lost 200 billion. Or
yeah, and you know, I mean, they faced well, they were able to mark their assets using a historical cost regulatory system. So that, combined with their government guarantee, meant that they didn't have to face up with their problems as they were developing.
This is a regulation problem, isn't it?
I like Jamie Dimon's answer at the summit 2 years ago, a lot better than where we're evolving to here. Jamie Dimon said, look in the mirror. Every class of actor in the financial markets made mistakes and caused this crisis. I mean, Congress gave an unbudgeted subsidy to people to buy houses who couldn't afford to buy their houses, and they asked Wall Street to find a way to do it. The credit agencies didn't do their job. Institutional investors didn't do their job. Senior managers of banks didn't do their job. I mean, this is Jamie Dimon talking, and I think he's right. I think all of us who are in this market, one way or another, regulators, bankers, credit agencies, congressmen, Frank, Barney Frank to start, I need to look in the mirror and say, we behaved in a way that led to a mess.
The second part of my question then is, do you think Glass-Steagall should ever have been repealed?
I say yes, but what do you guys say?
I'm not sure what would have happened differently if Glass-Steagall hadn't been repealed. What transactions or what activities are you thinking of that occurred that people weren't able to do by the time Glass-Steagall was
investment bankers
repealed?
Together with commercial bankers, you get an interesting breed.
Inbreeding was the cause of it. Okay, we're out of time.
Yeah.
Any one of the panelists want to add something, because we're out of time?
Yeah, I mean, the problem is that if you had the major issue, I agree with you that basically it's a too big to fail problem, or the idea that you have the moral hazard problem. If the government is going to bail out banks, then who are they bailing out? But if there was a rule that said, okay, depositors should have money market accounts outside of the bank, and those are guaranteed because that's the product those depositors want. If a bank raises money by deposits and by going to the markets. So the idea is if they go to the markets, then if the markets discipline them and the government is not going to bail them out, we'd have had a different outcome from the start, because that's the major point. I agree with you on that.
I agree with Myron on that, as usual.
Okay. For those of you that didn't see, The Economist had a series of articles called, not the girl with the dragon tattoo who played with fire, but entitled Playing with Fire. Those sets of articles are here up on the podium if you want to pick them up and you missed it. Thank you to the panel. Thank you very much. I thought it was very good.